In this module, we'll review the general characteristics of the health savings account. So let's take a look at the major characteristics of the health savings account, starting at 12 o'clock with that orange slice. Tax-free contributions from federal and, in most cases, state tax. So you've got these contributions from the health savings account that right off the bat is saving on the federal and most likely state tax. There's only 2 states that have a income tax that do not allow residents to avoid tax on their HSA contributions. That's California and New Jersey. In addition to the tax-free contributions from federal and state, if contributions are made pre-tax, you're saving on the payroll tax. So that 7.65% at minimum of FICA is also saved if the employer offers the HSA as an option on the 125 cafeteria plan. There's 7.65% at minimum savings on the payroll tax for the individual. And by the way, that also is saved by the employer. So on both sides, no income limits with the HSA. Regardless of your income, you're able to take advantage of the tax benefits of the HSA. Contributions do not have to be from earned income. And in addition to the money going in tax-free, earnings also grow tax-free. So you've got that money going in and growing tax-free through investments or interest. And then it's portable. It is an individual account. That money, once it's deposited into the HSA, is the individual's to do with what they choose, which includes moving the money to another HSA provider because they have better investment options, they like a provider better, or they've left an employer. So a lot of flexibility with that health savings account as well. The HSA is triple tax-free. We hear that a lot. So what exactly is meant by triple tax-free? Any money going into the HSA, contributions into the HSA, are done tax-free, with the exception on the state tax of what we spoke about with regards to Alabama, California, and New Jersey on the state tax. But federal tax is always going to be on a tax-free basis. And that doesn't matter whether or not the money comes from an employee, the employer, family member, irrespective of the source. The money goes into the HSA tax-free, grows through interest earned and investment of assets, again tax-free, and then withdrawals for qualified medical expenses, also tax-free. That's the triple tax-free. Money's going to go in tax-free, grow tax-free, come out tax-free, never paid a dollar in tax in that case. Now, if you take money out of an HSA for other purposes prior to turning age 65, for a non-qualified medical expense prior to age 65, you will pay ordinary tax plus a 20% penalty, But at age 65, that 20% penalty goes away. At age 65, it's just you're paying ordinary tax. So with regards to HSA withdrawals, withdrawals for qualified medical expenses are always going to be tax-free. Now, prior to age 65, withdrawals for non-qualified medical expense, the individual pays ordinary tax plus a 20% penalty. At age 65, the HSA really becomes like a 401k on steroids. If you use it for a qualified medical expense, tax-free. If you use it for a non-qualified medical expense for any other purpose, you simply are paying ordinary tax on that dollar amount, just as you would a 401k. If you still have questions with regards to this module, please email us at info@accesspointhsa.com.